6:02 a.m., April 14th, 2026. Denver, Colorado. 14 federal vehicles moved simultaneously through 6 different zip codes. Estimated cash seized before noon, $88 million. The targets weren't banks. They weren't warehouses. They were dispensaries. Licensed, state-regulated cannabis retail shops with business awards on their walls and Employee of the Month photos in their lobbies. Shops that filed tax returns, maintained payroll records, and operated under full visibility of Colorado state regulators. That was precisely the point. What agents from IRS Criminal Investigation and the Bureau of Alcohol, Tobacco, Firearms, and Explosives found inside those 14 locations that morning wasn't just cash. It was the infrastructure of a laundering operation that had processed cartel money through the cannabis retail system for 3 years, exploiting a gap in federal banking law so precisely that investigators later described it as the most technically sophisticated cash washing scheme they had encountered in the domestic drug money space. The scheme worked because of a single structural fact. Cannabis dispensaries cannot access federal banking. Because marijuana remains a Schedule I-controlled substance under federal law, no federally insured bank can legally service a cannabis business. Dispensaries operate entirely in cash. Every transaction, every payroll run, every supply invoice, paid in physical currency. And because the volume of cash moving through a cannabis retail chain is inherently enormous, and because that cash is inherently difficult to verify against actual customer counts, a cartel looking to introduce bulk drug proceeds into the legitimate financial system had found, in licensed Colorado dispensaries, something close to a perfect vehicle. But the operation that IRS Criminal Investigation and ATF dismantled in April 2026 didn't start with a wiretap, or a confidential informant, or a cross-border surveillance package. It started with a spreadsheet, and one IRS examiner in Denver who looked at a column of numbers and couldn't make them add up. Her name was Rachel Voss, Senior Revenue Agent, IRS Criminal Investigation, Denver Field Office. 11 years with the agency. She had spent the better part of a decade reviewing tax filings of cannabis businesses, a specialized niche that most IRS examiners avoided, given the legal complexity and the sheer volume of cash-based documentation involved. In November 2025, Voss was conducting a routine compliance review of a mid-sized cannabis retail group operating under the registered trade name Greenline Holdings, LLC. The group held state retail licenses for 14 dispensary locations spread across Denver, Aurora, Lakewood, Arvada, and Thornton. A substantial footprint, but not unusual for the consolidated cannabis market that had emerged in Colorado after a decade of legalization. What was unusual was the revenue figures. Voss pulled monthly gross sales reports for all 14 locations, cross-referenced them against the state excise tax filings Greenline had submitted to the Colorado Department of Revenue, and ran a simple comparison: daily average revenue per location across a 12-month period. The numbers were identical, not similar, not within a normal variance band. Identical, to the dollar, in many cases. Across 14 retail locations operating in different neighborhoods with demonstrably different demographics, foot traffic patterns, and competitive landscapes. A dispensary on East Colfax Avenue in a high-density corridor was reporting the same average daily cash intake as a location in a suburban strip mall in Arvada. A flagship store near Capitol Hill matched, figure for figure, a smaller shop serving a residential area in Thornton with a fraction of the foot traffic. In a legitimate retail business, that is mathematically impossible. Daily revenue in any cash-intensive retail operation fluctuates constantly. Weather affects foot traffic. Local events drive spikes. Competitor openings suppress nearby sales. Seasonal patterns shift purchasing behavior. 14 geographically dispersed retail locations reporting near-identical daily averages across 12 months wasn't a statistical anomaly. It was evidence that the numbers had been manufactured. Voss flagged the case for criminal referral in December 2025. What she didn't know yet, and what would take investigators 4 more months to fully map, was the scale of what she had found. The $88 million figure that would appear in the April 2026 seizure affidavits represented only the cash physically on hand at the time of the raids. Financial analysts working the case later estimated the total volume of cartel proceeds laundered through the Greenline network over 3 years was closer to $340 million. Voss had found the edge of something much larger than a tax compliance problem. The criminal referral moved from IRS CI Denver to the agency's Financial Crimes Division within 2 weeks. By early January 2026, the case had a Joint Task Force designation. IRS Criminal Investigation working alongside ATF's Financial Investigations Unit with support from the DEA's Denver Field Division and the U.S. Attorney's Office for the District of Colorado. The lead case agent on the ATF side was Special Agent Daniel Mercer. 11 years in financial crimes, the last 4 working money laundering cases with a cartel nexus. He had seen cannabis-adjacent laundering before. Smaller operations, typically involving a single retail license and a straightforward cash skimming arrangement. What Voss had found was categorically different. A purpose-built laundering infrastructure using a licensed retail chain as its central mechanism. Mercer's first task was to understand how the cash actually moved. The Greenline holding structure was, on paper, entirely conventional. The parent LLC was registered in Colorado, held the master retail license, and employed a general manager, a compliance officer, and a centralized accounting function. Each of the 14 locations operated as a sub-entity under the master license. Daily cash proceeds from each location were logged by on-site managers, bagged, and picked up by an armored courier service. A licensed Denver area firm called Western Vault Solutions, which transported the cash to a central counting facility in Aurora. From the Aurora facility, funds were processed and deposited into a series of accounts at a Colorado chartered state bank, one of the few financial institutions in the state that had developed a compliance framework specifically to serve the cannabis industry, operating under a regulatory exemption from the state's banking regulator rather than federal charter. On paper, legal cannabis revenue flowing through a legal banking relationship. In practice, something else entirely. The investigation team spent January and February 2026 tracing the cash flows backward. Not forward from Greenline's bank accounts, but backward from the cash's origin point. Where was the money actually coming from before it entered the Greenline counting facility in Aurora? The answer arrived in early February, when surveillance teams around the Thornton Dispensary location captured footage that the case file would later describe as the operation's first definitive break. At 2:11 a.m. on February 3, 2026, a gray Chevrolet Silverado with Colorado commercial plates pulled into the loading bay behind the Thornton location. 2 men got out. They carried 4 large duffel bags into the building through the rear service entrance. They were inside for 11 minutes. When they left, the bags were noticeably lighter. The Silverado was registered to a landscaping company in Commerce City. The landscaping company had filed no federal tax returns since 2023. Its registered address was a UPS store mailbox. Agents ran the vehicle's plates through 60 days of commercial toll records across the Denver metro area. The Silverado had made 43 trips to various Greenline locations during that period, always between 1 a.m. and 4 a.m., always to the service entrances, always carrying duffel loads in. This was not armored courier activity. Western Vault Solutions operated on a daytime schedule with documented manifests and commercial insurance logs. Whatever was arriving in duffel bags at 2 a.m. through rear service entrances was not part of the authorized cash handling chain. It was being introduced into the system before the authorized counting process began, mixed in with legitimate daily revenue before the bags were handed to Western Vault Solutions the following morning. And because all 14 locations were reporting identical daily totals regardless of actual customer volume, the manufactured figures weren't being calculated location by location. They were being assigned, a fixed number distributed across the chain to absorb whatever cash volume needed to be washed on any given day. The bookkeeping function that made this possible was housed not at Greenline Holdings itself, but at a third-party accounting firm in Aurora named Meridian Business Solutions, LLC. Meridian had been incorporated in 2022. It listed 3 employees and offered bookkeeping, payroll, and tax preparation services to small and medium businesses. Its client list, according to state business records, included 17 companies, most of them in service industries with significant cash components. Greenline Holdings was listed as Meridian's largest client. When investigators began pulling Meridian's financial records, they found the firm had processed over 4,000 invoices on behalf of Greenline Holdings across the 3-year period. The invoices covered a range of services: supply chain expenses, facility maintenance, marketing, consulting. Many were addressed to entities that IRS analysts could not locate in any business registry. Shell companies with no registered agents, no employees, and no discernible operational activity. The fake invoices served 2 functions. First, they created paper justification for cash outflows from the Greenline system, money flowing to vendors who didn't exist, which the IRS couldn't easily identify as laundering exits because the vendor documentation appeared superficially complete. Second, they provided the mechanism for proceeds to re-enter the legitimate economy through real estate. One detail in the Meridian records that stuck with the investigation team: a single consulting invoice dated October 2025 for $847,000, addressed to an entity called Pinnacle Strategic Group, LLC. The invoice described market expansion advisory services. Pinnacle Strategic Group had been registered in Wyoming in September 2025, 6 weeks before the invoice was issued. It had no employees, no office address, and no prior operating history. Its registered agent was a law firm in Cheyenne that provided registered agent services to over 4,000 LLCs simultaneously. That invoice, and 11 others like it, had been used to move approximately $9, $4 million out of the Green Line system and into real estate acquisitions across the Denver metropolitan area. I spent time going through the property records on this, and one pattern kept appearing that wasn't obvious at first. Every real estate purchase linked to the Meridian invoice chain had been transacted through a Colorado licensed broker, paid in cash or cashier's check, and closed without a mortgage. In a normal market, an all-cash real estate transaction attracts heightened scrutiny from title companies under FinCEN's geographic targeting orders. But the purchases were deliberately spread. No single transaction exceeded $500,000, keeping each one below the GTO reporting threshold for the Denver metro area. 17 properties, 11 residential, 6 commercial. Purchased between early 2023 and late 2025. Total acquisition cost, approximately $6, $8 million. Estimated current market value, $9, $1 million. The real estate portfolio had already generated a $2, $3 million paper gain. Legitimate equity and assets purchased with cartel proceeds. This is where the scheme crossed from sophisticated to systemic. The real estate acquisitions weren't being managed by Green Line Holdings or Meridian Business Solutions. They were held in a web of individual LLCs, each registered in a different state: Colorado, Wyoming, Nevada, New Mexico, with ownership structures running through a series of nominee holders. At the end of each ownership chain, investigators eventually found a connection to a single individual, a dual citizen with Colombian and U.S. documentation who had no visible connection to the cannabis industry and who had not entered the United States since 2023. His name in the case documents was listed only as Subject A. The investigation had not been able to locate him by the time the April raids were executed. He remains unaccounted for. By mid-February 2026, agents understood that the Green Line laundering network had 3 distinct layers. The first was the retail dispensary chain itself, which provided the cash absorption mechanism. Real drug proceeds entering the building in duffel bags at 2 a.m., mixed with legitimate revenue and reported as cannabis sales. The second was the Meridian bookkeeping operation, which generated the false invoice paper trail to justify outflows and obscure the gap between actual sales and reported figures. The third was the real estate portfolio, which converted laundered cash into appreciating hard assets held behind nominee structures deliberately designed to be difficult to trace. And sitting underneath all of it, providing the cash that needed to be washed in the first place, was a drug distribution network that agents had not yet fully mapped. This is what most people assume about money laundering investigations, that finding the laundering mechanism leads immediately to the underlying crime. It often doesn't. The people running the cash washing operation are frequently insulated, by design, from direct knowledge of where the money originated. The Green Line network appeared to be structured exactly this way. The men delivering duffel bags to the loading bays at 2 a.m. were runners, low-level couriers with no apparent connection to whoever had hired them. The shell companies receiving the fraudulent invoice payments were intermediary layers. The real estate portfolio was managed through nominees who, in at least several cases, appeared to have legitimate professional backgrounds with no prior criminal history. What's most surprising about a case like this isn't the sophistication of the scheme. It's how long it operates before a single number in a spreadsheet catches the attention of someone who knows what impossible looks like. Rachel Voss had looked at that spreadsheet in November 2025, 3 years after the operation had begun. The question agents were now working against a deadline to answer was, how much of the broader network could they map before executing the raids? And how much would collapse into the shadows the moment the dispensary doors were forced open? The surveillance operation running through February and March 2026 was the most resource-intensive phase of the case. IRS, CI, and ATF had assembled a task force of 37 agents and analysts, supplemented by DEA surveillance personnel and a financial crimes prosecutor from the U.S. attorney's office managing the warrant applications in real time. The task force established fixed surveillance positions around 8 of the 14 Green Line locations, with mobile teams rotating coverage of the remaining 6. License plate readers were deployed on primary approach routes to each location. The gray Silverado linked to the February 3rd duffel delivery was placed under round-the-clock GPS monitoring after agents obtained an order from a federal magistrate in Denver. What the surveillance produced over 6 weeks was a detailed operational map of the cash delivery network. The Silverado made 31 additional deliveries to Green Line locations between February and early April. Not always to the same locations, and not always with the same individuals. The investigation identified 6 different vehicles making similar deliveries, all operating on a rotating schedule that appeared designed to prevent any single vehicle from becoming a pattern. The vehicles traced back through registration chains and GPS data to 3 distinct staging points in the Denver metro area, a storage facility in Commerce City, a commercial garage unit in Aurora, 3 miles from the Meridian Business Solutions office, and a residential property in Lakewood purchased in 2024 through one of the Shell LLCs in the Green Line Network's real estate portfolio. Agents mapped the cash flow from staging point to dispensary loading bay, from loading bay to counting facility, from counting facility to the state bank accounts, from bank accounts to Meridian's invoice processing, from Meridian's invoice payments to the Shell LLC recipients. The entire cycle, from drug cash entering the system to laundered proceeds arriving in a legitimate-looking bank transfer, took between 14 and 21 days per cycle. The operation ran approximately 4 cycles per month. At peak volume, in the spring of 2025, agents estimated the network had been processing between $8 million and $11 million per month in cartel proceeds. Then came the first real obstacle. In mid-March 2026, with warrant applications drafted in the U.S. Attorney's Office preparing to move toward a raid timeline, the surveillance team monitoring the Commerce City storage facility reported that activity had gone quiet. No vehicle movement in 6 days. No deliveries to Green Line locations from the usual rotation. The gray Silverado, tracked through its GPS unit, hadn't moved from a parking structure in Thornton in 4 days. The network had slowed, or it had been tipped off. Mercer made the call to hold the warrants. Running the raids while the cash delivery side of the operation was dormant would seize whatever cash remained in the dispensaries from recent legitimate sales. But it would miss the operational infrastructure that had been building the duffel delivery network for 3 years. The goal wasn't just to close the dispensaries. It was to document the full operational picture before execution. For 8 days, the task force held position and ran expanded surveillance, trying to determine whether the operational pause was routine, a temporary stop to avoid heat, or a sign that someone inside the network had received warning. On March 24th, the Silverado moved again. The Commerce City staging facility reactivated. 3 other vehicles in the rotation resumed their pattern. Whatever had caused the pause, it had passed. Mercer set the execution date for April 14th, 2026. Here's the take that'll probably get us some pushback. The federal cannabis banking prohibition, the policy that made this entire scheme possible, has been flagged by law enforcement, policy researchers, and financial regulators as a structural laundering risk for over a decade. The inability of cannabis businesses to access federal banking doesn't just inconvenience legitimate operators. It creates a mandatory cash-only environment that is, by design, ideal for money laundering. The Green Line Network didn't invent this vulnerability. It industrialized it. And the question of who bears responsibility for a policy architecture that hands cartels a ready-made laundering mechanism, that question doesn't get answered in a seizure affidavit. What do you think? When a federal policy creates the structural conditions for a crime at this scale, does the law enforcement response address the real problem, or just one instance of it? The week before the April 14th raids, the task force executed one final intelligence action, a quiet review, coordinated through the Colorado Department of Revenue, of Green Line Holdings' state cannabis retail licenses. The licenses were valid. The compliance record, from the state's perspective, was clean. Green Line had passed every state inspection it had been subjected to. Its track record with state regulators was, on paper, exemplary. This was not an accident. The compliance record was one of the scheme's deliberate assets. A cannabis retail chain flagging regulatory problems would attract exactly the kind of scrutiny the operators wanted to avoid. Green Line had been run as a professionally managed retail business precisely to insulate it from state-level attention. The operators understood that the licensing relationship with Colorado regulators was a protective layer, and they had maintained it accordingly. On the morning of April 13th, the day before the raids, Mercer received a call from the DEA's Denver division. A source unconnected to the Greenline case had provided information suggesting that at least one individual with knowledge of the dispensary network's true function had been in contact with associates in the prior 72 hours. The task force couldn't confirm what had been communicated or to whom, but the possibility that the network had been alerted meant the raid timeline could not slip. The April 14th execution window held. The only adjustment: the breach time was moved forward by 45 minutes, from 6:47 a.m. to 6:02 a.m., to reduce the window in which any warning could translate into cash removal or document destruction. At 5:30 a.m. on April 14th, 37 federal agents and 31 support personnel staged across 6 rally points in the Denver metro area. 14 raid teams, each assigned to a single Greenline location. 4 evidence collection units positioned at the Aurora Counting Facility, the Meridian Business Solutions Office, and the 2 most active staging points identified during surveillance. A financial crimes team holding position at the State Bank branch holding the Greenline operating accounts, with a court order to freeze all associated accounts the moment the first dispensary door was breached. 2 helicopters from the DEA's Rocky Mountain Aviation Unit were airborne by 5:45 a.m., providing overwatch on primary approach routes and monitoring for vehicle movement out of the known staging locations. At 5:58 a.m., all 14 raid teams reported ready. At 6:02 a.m., Special Agent Mercer gave the execution order. The East Colfax location was the first entry. The team assigned to it: 8 agents, 2 IRS forensic accountants, and a SWAT element from the Denver FBI field office breached the rear service entrance at 6:0214 a.m. The store manager, who had arrived early for an inventory run, was detained in the back office without resistance. The safe in the manager's office contained $214,000 in banded cash. The walk-in counting room adjacent to the safe held an additional $880,000 in rubber-banded currency sorted by denomination, a volume the on-site manager would be unable to explain by reference to the previous day's sales receipts. Across the city, all 14 entries were completed within 4 minutes of the initial breach. No injuries were reported. 3 individuals were detained on-site across the 14 locations, managers and shift supervisors who had been present at opening. None were the primary targets of the operation's arrest warrants. The primary targets: the operators of Greenline Holdings, the principals of Meridian Business Solutions, and the registered agents of the key shell companies, were arrested at separate locations between 6:15 a.m. and 8:40 a.m. 5 individuals taken into custody in total. A sixth: the individual identified in case documents as Greenline's operational controller, the person investigators believed had structured the cash delivery schedule and managed the relationship with the cartel side couriers, was not at his registered address when agents arrived. A warrant remained outstanding as of the close of the raid day. The forensic accounting team spent 11 hours at the 14 dispensary locations in the Aurora Counting Facility. By 5 p.m. on April 14th, the preliminary cash count stood at $88, $3 million. Real estate deeds for the 17 properties in the Shell LLC portfolio were seized from the Meridian offices. Bookkeeping servers, 3 rack-mounted units that Meridian had been operating on behalf of Greenline, were imaged on-site and removed for forensic analysis. Among the documents seized at the Meridian office was a handwritten ledger, a physical record, maintained in Spanish, that listed cash delivery volumes by date and location code. The ledger covered a period from March 2023 through January 2026. Investigators described it as the most complete manual record of a laundering operation's cash intake they had encountered in a domestic financial crimes case. That ledger, more than any other single piece of evidence, defined the scope of what the Greenline network had actually processed. The figures it contained, total cash introduced into the system across the 3-year operating period, aligned closely with the $340 million estimate that financial analysts had been projecting from the bank record analysis. Of that amount, $88. $3 million was seized on April 14th. The real estate portfolio, valued at $9. $1 million was subject to civil forfeiture proceedings. The remainder, approximately $242 million in laundered proceeds that had already cycled out of the system through the Shell invoice network and through cash deliveries to the cartel side, was not recovered. Put yourself in Rachel Voss's position for a moment, sitting at a desk in November 2025, looking at a column of numbers that didn't add up, with no way to know that those 14 matching figures represented the visible edge of a $340 million operation that had been running, undetected, for 3 years. The case didn't start with a wiretap or a confidential informant or a surveillance package. It started with someone who looked at a spreadsheet and knew what impossible looked like. The 5 individuals arrested on April 14th faced federal charges, including money laundering, conspiracy, structuring, tax evasion, and operating an unlicensed money transmitting business. Sentencing guidelines for the charged offenses, under federal statute, carried potential terms ranging from 8 to 20 years, depending on role in the conspiracy and the calculated laundering volume attributed to each defendant. The 6th individual, the operational controller identified in the warrant, remained unlocated as of the close of the investigation's initial phase. The DEA's Denver division, in coordination with the U.S. Marshals Service, maintained an active fugitive investigation. Of the 17 properties seized through civil forfeiture proceedings, 3 had been leased to third-party tenants who had no apparent knowledge of the property's connection to the laundering network. Their lease agreements remained in effect through the forfeiture process. The 6 drivers identified as cash delivery couriers, the men and women who had transported duffel loads to the Green Line loading bays across 3 years of operation, were identified through the GPS data and the license plate surveillance record. 3 were arrested alongside the primary defendants. 2 had left Colorado in the days following the raid. 1 could not be located. The Western Vault Solutions armored courier firm, which had operated the legitimate, documented cash pickup chain from the dispensary locations to the Aurora counting facility, was cleared of involvement by investigators. The firm's manifests, vehicle logs, and employee records established that its personnel had no knowledge of the pre-dawn duffel deliveries that preceded their morning pickups. Western Vault Solutions was not charged. The Green Line Holdings retail licenses were suspended by the Colorado Department of Revenue on April 14th, pending the outcome of the federal proceedings. All 14 dispensary locations were closed as of the raid date. The state bank that had held the Green Line operating accounts, operating under the state cannabis banking exemption that had made the relationship legal from a state regulatory perspective, was placed under a federal administrative review. The review was examining whether the bank's compliance function had followed its own anti-money laundering protocols in monitoring the cash volume moving through the Green Line accounts. What this case tells us about the structural conditions that enabled it is something the seizure affidavits don't fully capture. The Green Line network didn't find a loophole in the cannabis banking system. It found the banking system's absence and built a multi-year, multi-layer industrial laundering operation inside that absence. The federal cannabis banking prohibition exists as a consequence of federal drug scheduling law, not as a deliberate policy choice to create a cash-only environment. But the operational effect is the same. A mandatory cash ecosystem that is, by its own mechanics, resistant to the transaction monitoring tools that financial institutions use to flag suspicious activity in other industries. The Green Line case is not the first federal prosecution to expose cartel money moving through licensed cannabis retail. It will not be the last. Will this happen again? Comment why yes or no. Because based on what's in the case record, the structural vulnerability that made Green Line possible hasn't been addressed by the April 14th seizures. The $88 million is in federal custody. The real estate portfolio is in forfeiture proceedings. The Meridian bookkeeping servers are in an IRS forensic lab in Denver. 5 defendants are awaiting trial. 1 is still out there. And $242 million in cartel proceeds. Money that moved through licensed Colorado dispensaries, through a bookkeeping firm in Aurora, through 17 real estate transactions across 4 states, has not been recovered. The network is dismantled. The system that made it possible still exists. If cases like this matter to you, cases where the investigation starts with a single spreadsheet anomaly and ends with $88 million on a counting table, subscribe. The next case in this series involves a federal banking examiner, a fintech startup, and a wire transfer pattern that took 3 years to explain. You won't want to miss where that one goes.